Alright, hey, what's up guys? Scott here again with my next live trading video, and for this one, I'll be walking you guys through a real live trade here this morning in TWLO. I'm going to sell a short Strangle basically, and through that process, I'll be showing you guys the various tips and tricks that I've learned over the years with these kinds of strategies to improve both my profitability and my overall win rate. And also here, even though like I said, this video's focus is going to be on short Strangle trades, but pretty much everything I say in this video can be very easily applied to iron condors as well. So, those trades are basically the defined risk variants of these strangles. So if you prefer using those kinds of strategies, then again, pretty much everything I say in this video will be applicable to iron condors as well. Now also here guys, if you want to receive up to 13 free stocks from Moomoo for a very cool limited time opportunity, then make sure you watch until the end of the video. And then secondly here, if any of you would like to join a very exclusive online community where you can learn how to successfully trade options and learn my custom approach to the markets, then you can now join my options trading Discord. So definitely make sure to check out the description of the video below to learn a lot more about that. And then finally here, for anybody who is brand new to the channel as well, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1-month free trial. Alright guys, so now diving in here, and the first and most important tip when it comes to selling strangles or really any kind of options selling strategy is to make sure the stock you want to trade here has high implied volatility. Now quickly, in case you're not aware of what implied volatility is, it's basically just a measurement of uncertainty about a stock's future. And more specifically, it does have to do with a future expected price range for, in this case, TWLO stock. And basically the higher implied volatility gets, or basically the wider this future expected price range gets, then the more expensive option prices become. Right, and that's because implied volatility is one of the many factors used to price option contracts. So again, like I said, when implied volatility expands or goes higher, so do option prices. And then conversely, when implied volatility goes down, option prices go down along with it. And so in regards to TWLO here, if we come down to this bottom chart, let me expand this up a little bit. So this chart is depicting the implied volatility for TWLO over the past 1 year. And so take note that across time, implied volatility has a tendency to rapidly expand and also rapidly contract. There's lots of fluctuations. And actually, if I zoom out a bit more here on this chart, then now you can really see just how much the implied volatility for TWLO has fluctuated in the past 1 year here. And so like I was saying, around these points when implied volatility is very high, and therefore there's a lot of uncertainty about TWLO's future for whatever reason, then it's during these kinds of moments where TWLO's options are very expensive. And oftentimes these moments of increased uncertainty do coincide with earnings announcements, which you can see right here for TWLO. And then typically after these announcements, you will see the implied volatility come back down. Now that being said, even after this pretty big drop in implied volatility, the current value at around 72% here is still much higher than usual for this stock. So bottom line is whenever you do sell options in general, right, not just in regards to strangles, but really any kind of options selling strategy, you want to find stocks that have high implied volatility in pretty much any market environment. So again, in the case of TWLO here at 72%, this is much higher than most other stocks. But then also you want to find stocks where the implied volatility right now for that stock is much higher than usual for that stock. And the reason for that is implied volatility is very cyclical in nature, right? So whenever you see a spike in implied volatility or a large elevation, it usually comes back down. And then conversely, when the IV gets too low, it'll come back up and basically just fluctuate around a long-term average, right? So for TWLO here, it looks like the IV for the stock likes to hang around in between a range of maybe about 40% on the low end and then around 100% on the high end. And right now the implied volatility is pretty close to right in the middle, but still on the upper end. So therefore, there still is some great potential for the implied volatility to contract even further. So ultimately here guys, the big picture is that when you do sell options with stocks that generally have high implied volatility anyways, typically above 40 or 50%, so TWLO obviously satisfies that requirement, that's going to allow you to sell options again in most environments for decent amounts of premium. And that's very important, right? Because the size of your profits depend directly on how much premium you can collect when you sell these options, right? So again, that's why selling options on stocks with high implied volatility in general is important. But also when the implied volatility is much higher than usual for that stock as well, that's an extra advantage, right? Because especially at around these points where the IV is much, much higher than usual, there's a very good chance you will see a large contraction thereafter. So bottom line is if you sell options at this point when they have their highest possible prices, and then if implied volatility contracts significantly after that point, well, like I explained earlier, that's going to bring down the prices of your contracts significantly. And that's exactly what you want, right? Whenever you sell options, you always want the prices of your contracts to decrease across time. Now, next up here, in regards to the actual price action chart, it's very important to find stocks. Let me go ahead and zoom in here a little bit. It's very important to find stocks that are nicely range bound for this kind of strategy, right? Because strangles and iron condors and things like that, straddles as well, these are directionally neutral strategies. So ideally, you want the stock to simply move sideways across time. And so for TWLO here, as you can see, this stock has been range bound very nicely for the past 2 months or so. And this range has very clearly defined resistance and support levels. So support comes in at around $80 per share, and then resistance comes in at around $100 per share. Right, so for example, as you can see back during this time, this line was acting as support, right? TWLO was refusing many, many times to go below that point, but eventually the support did fail, and therefore it flipped into resistance, right? So obviously, as you can see here and here, both times where TWLO tried to get back up to that price, it failed and it was repelled lower. And then for the stock's new support level at around $80 per share, it's pretty obvious there were many times where the stock got down to that price and it would not go lower, right? So at least for the time being, TWLO has always found buyers willing to buy the stock and bid the price back upwards at around $80 per share. So bottom line, at this price, TWLO for the time being is at a discount according to the broader market. And then at this price at around $100 per share, TWLO is too expensive. Now, of course, these lines can change depending on what happens with this company going forward. But oftentimes when a stock does get very stuck in a range like this, it's very difficult for it to break out either to the upside or the downside, right? Basically, there has to be some major market event or some news event relating to TWLO in particular that forces the market to basically reprice this company. And so once I have identified the upper and lower bounds of this range right here, these prices are going to dictate these strikes that I choose for my strangle. And typically for me, I do like to be on the safer side of things, so I'm basically going to sell my call strike above this resistance and my put strike below this support, right? So basically in doing so, I'm just giving myself a little bit of cushion, so to speak, in case TWLO decides at least briefly to break out of this range. And so with that being said, now we'll come back to the trade tab here and take a look at the option chain for TWLO. Now, generally speaking, the monthly contracts, which you can see here in gray, these are going to have the best liquidity, or basically the most trading activity. And that's very important because if, for example, we go into the September monthly expiration, I'll unfold this tab here. As you can see, for one thing, the volume and open interest for these contracts, these are the calls right here, the volume and the open interest is pretty darn good, right? So essentially what this means is there's lots of people in the market that are actively trading these contracts. And that's important because obviously you need someone to take the other side of your trade. And also with good liquidity, you'll have very tight bid-ask spreads here. So for most of these contracts, the difference between the bid price and the asking price is only about 10 or 15 cents wide. That's pretty darn good. So therefore, if you trade these contracts, you will get filled at very good prices on your orders. And that's very, very important. Whereas conversely, if we check out maybe the September 30th weekly expiration, let's unfold that tab, and boom, there you go. No volume, no open interest, very wide bid-ask spreads. So regardless of what you're trading, options, futures, stock, buying them, selling them, does not matter. For trading in general, you have to have good volume and tight bid-ask spreads. Now also with options in particular, we have this concept of time decay, right? Where as time moves forward, the prices of all option contracts will slowly decrease in value. And so as an option seller, time decay is always on your side, right? Because As I explained, whenever you sell option contracts as your opening trade, you want the prices of those contracts to decrease. And that's exactly what time decay will help with. Now, that being said, though, depending on the expiration date you choose, the time decay will affect those options in a different way, right? So basically, the closer you are to expiration, the more and more time decay will accelerate, and therefore the prices of those options will fall faster and faster and faster. And so time decay generally starts to accelerate around 45 days until expiration, and it simply gets faster and faster from that point. Now, that being said, though, you also don't want to go too close to expiration, because if you, for example, sell options with only 1, 2, or 3 days left to go, the premium collected on those contracts is going to be very, very small, right? So essentially, there is a fine balance between selling options with enough time until expiration, so therefore you can collect decent premium, but also not going too far out in time so that the time decay is not having much of an impact. And for me personally, I have found the best application of this concept by selling options around 30 days until expiration and going as soon as 2 weeks until expiration. So anywhere between 2 to 4 weeks basically is the sweet spot for me. Now, of course, you definitely can go a bit beyond that point or go a bit sooner than that point. But again, I have found the best balance, at least, between good premium and fast time decay between 2 and 4 weeks. And so that means for this trade here, I'll go into the September monthly expiration with 32 days left to go, close enough to 30, that's fine. And again, like I showed you on the chart, the resistance point for TWLO right now is at around $100 per share, and support is at around $80 per share. And so, like I explained, just for added cushion, I'm going to sell my options a bit beyond those points. So for the put side, I'll sell the 75 strike put option, and then for the call side, I'll sell the 105 strike call option. And as you can see here, the deltas on these contracts are both 19 or 20, very close to each other. So therefore, this strangle here is almost perfectly directionally neutral, right? So basically, as of the current moment, I'm not taking any directional bias with this trade. And that makes sense because if we go back to the charts real quick here, TWLO is pretty much right in the middle of this range. So if, for example, TWLO was towards the upper end of this range or towards the lower end of this range, I would probably skew my strangle to have more of a directional assumption, more bullish down here and more bearish up here. But again, because right now we're basically right in the middle, I'm not taking any directional bias. So with that said, we'll come back to the trade tab here and make this trade official. And so I'll right click on the call option here and go to sell and strangle. And here we go. This is the order to sell one contract, 105 strike call, and also sell one contract of the 75 strike put option. And total premium collected is about $370. I'll lock in exactly 370 here. That's not too bad. And then next we'll go to confirm and send and check out the buying power effect for this trade, or basically the capital requirements. Right now it's about $900, a bit less, and that's totally fine. So my general rule of thumb here is to never risk more than 5% of my account when placing one trade. So for this account here, $900 is about 1.8%, I think, just an estimate, but definitely far less than 5%. So with that said, the risk here is good, so we'll go to send. And there we go, just got filled at exactly 370. Awesome. And so there we go. I'm now officially in this trade, and like I was explaining earlier, the whole point of this position is for TWLO to hopefully continue trading sideways in that nice range. Also for time decay to continue doing its thing and always working in my favor. And then also, of course, I want to see some implied volatility contraction. But then finally here, one last tip I have for these kinds of trades, and really any kind of option selling strategy as well, is to take your profits early, and also to use automatic closing orders to take your profits automatically, right? Because especially with option selling strategies, your max profit is always defined when you make the trade. Your max profit is literally the credit you have collected on trade entry. So therefore, if perhaps you've already made most of that max profit well before the expiration date, because the prices of your contracts have fallen substantially, then in my opinion, there's no need to continue holding the risk on this trade all the way to the expiration date to make that max profit, right? So for example here, let's say a week goes by and the value of the strangle drops by 50%. I'm going to go ahead and take my profits at that point, right? Because otherwise I would have to wait another 3 weeks basically at that point to make the next 50%. And that's a lot of time, of course, for the stock to potentially move against my position here and take back all those profits. So therefore, what I'm going to do here is right click on the call option and go to buy and strangle. And so this order now is going to be my closing order that's going to automatically take profits if the value of the strangle ever falls down to my profit target. And so for me personally, I typically take profits at 50% of the max possible profit. So I sold the strangle for 370 in starting credit. Half of that is 185, right? So essentially, if the entire value of the strangle here falls down to a price of 185, then at that point, this order here will get triggered. I'll buy back both contracts and take my profits. So last step here is to make this a GTC order so it's always in place until either it does get executed or I cancel it myself. And then finally, we'll just go to confirm and send that order. Now also, unlike iron condors, where those have defined risk from the beginning of the trade, if you trade strangles or basically any kind of short naked option strategy, you do have undefined risk. And so therefore, having good trading defense is absolutely crucial. Now that being said though, when you do sell naked options, there are tons of different ways and approaches you can manage and defend these kinds of positions. So I'm not going to go into all those kinds of management styles in this video, but I do have a separate video that will show you guys in detail how I personally defend these kinds of trades. So if you do want to see that video, I'll post a link to it above so you can watch it next. But anyways, that's going to do it for this one here. I hope you enjoyed it, and let me know your thoughts or if you have questions in the comment section below. But of course, one final thing in this video, as I mentioned at the beginning, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my SKILLSHARE courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.